We're in the realm of what we call financial accounting, which is the process of trying to create information that's useful to investors. The primary tool for investors and creditors to get information about a business are the financial statements, to be prepared in accordance with generally accepted accounting principles. We did some manual work, but they need to have an accounting system in place that is designed to generate the information that will be included in those financial statements available to investors and creditors. Some of the most basic elements, and you'll remember this, in an accounting system is that all of the transactions of a business must be identified, and then they must be recorded in some way as to recognize the impact that they have on the financial statements. And then it has to be summarized in some kind of an organized way. That's done through posting journal entries to a general ledger. And then finally, we can take those balances from those summarized accounts in the general ledger and actually create some financial statements. Today, we're going to actually discuss some additional steps which need to be implemented in this accounting system in order to produce accurate financial statements. Kind of maybe want to ask you a few questions that I think will be interesting and will also serve as some review for us. I guess the question that I'd like to ask you is this: what kind of a balance, debit or credit balance, would you typically expect for an asset account, for example, cash, at the end of an accounting period? Well, I'm going to pull out the trial balance, and here is the trial balance, and you will notice that at the end of the month of June, the first month of operations for that had a cash balance of $170. It was a debit balance. The other assets, inventory, accounts receivable, either had a zero or a debit balance. Notice that accounts payable and notes payable liabilities either have a zero balance or credit balance. Owner's equity, capital stock, has a credit balance. Is it possible that cash could actually have, at the end of any period, a negative or a credit balance? Well, if you look at the general ledger account for cash, you'll notice that we had a beginning balance at zero as we started the business, and then we had various inflows and outflows. Theoretically, you've either got a balance of cash or you have zero cash. The running balance of cash should be positive or on the debit side. On a cumulative basis, we should always have more inflows than outflows. Otherwise, you'd have really negative cash. How can you possibly have a credit balance at the end of the period? Well, theoretically, you shouldn't. But occasionally, my personal cash account does have a negative, or as we're describing it here, a credit balance. This is very simple. It writes checks on the account when we don't have any money in the account. Theoretically, if you write a check, I suppose you would say, hey, we've dispersed cash, and you make a credit entry to the cash account in excess, potentially, of the balance of cash that you might have. If that were to actually happen, and you wrote checks in excess of any running balance of cash that you'd have, theoretically, you would have a credit balance in the cash account. But is that really cash then? In fact, if you were preparing a balance sheet at that point in time, what would you do? How would you disclose that? How would you actually include that on the balance sheet? Would it be cash with a negative number? Well, let's think about that for a second. If in fact we wrote checks on our account in excess of the cash balance that we have, we'd probably get a phone call. The bank calls us and say, hey, we've got a little problem here. Now, we've honored your check, but they exceed the balance. You have insufficient funds. You've got a check, they'd say that it bounced, but in this particular case, they like me, they like my business, and they say, we've gone ahead and processed the check and honored the check, but you better get down here quick with some cash because you owe us. In fact, if we write checks in excess of the cash balance that we have, yielding a credit balance in the cash account, it's not cash at all, and it's not negative cash. What is it, really? Well, it's a liability. At this point in time, we actually owe the bank because they've honored checks in excess of the cash. They're calling us and saying, bring down some money, you owe us. And they'd be absolutely right. If in fact you have a credit balance in cash, what you really have is a liability, and you probably should disclose that in the financial statements in that case. But generally speaking, the balance in cash, if we have cash, is going to be a positive balance where our inflows have exceeded our outflows on a cumulative basis and will be a debit balance. Is it possible to have a debit balance in a liability like notes payable? He had a general ledger account for notes payable that had a $200 credit balance. Notes payable or any liability, accounts payable, theoretically should always have a credit balance because you've either got a liability, you might have zero liability, so you might have a zero balance, but theoretically you'd never really have a debit or a negative balance in a liability. In fact, let's assume for a moment actually does pay off this obligation and accidentally pays $210. He just forgot how much he owed, miscounted or whatever, and actually pays $210 to pay off the note payable. In that particular case, the journal entry would be to credit cash for $210 and debit notes payable for $210. In that case, the balance would actually be a debit balance of $10 in that account. Is that a negative liability, or what really is it? In this particular case, what this really is this is a receivable. In fact, when he discovers that he has a $10 debit balance in notes payable, he's going to say, that seems kind of weird. And he'll look at the account and say, you know what? I actually paid more than I owed him. And now he really owes me. I've paid him too much. He needs to refund $10. So he comes in and says, hey, I paid you off too much there. You actually owe me $10. So a debit balance in a liability, like notes payable, isn't really a liability or a negative liability. What it really is a receivable. Dad owes him now $10 because the liability was overpaid. But again, that isn't too common. The traditional account balance for notes payable or any liability is a credit balance or a zero balance if in fact all of the obligations have been paid off. Now, let's do a problem, have you do a problem, and kind of test you to see if you kind of understand the concepts. Let's go over the solution. What is the most common balance for cash, which is an asset? Well, since cash is increased on the left or debit side, and we'd only have a balance if we had cash, we never really have negative cash, it would be really a liability. The balance of cash should be a debit balance. The inflows should have always exceeded the outflows, or we'd have a zero balance. The same with accounts receivable. You've either got a debit balance or a zero balance. Theoretically, you never have negative accounts receivable. In fact, if you did, you'd have an obligation or really an account payable in that case. Any liability, like accounts payable, theoretically should have a credit balance. That's true of owner's equity also. Capital stock would have commonly a credit balance. The same with retained earnings. If we've had retained earnings, we'll have a positive or credit balance because credits are increases to those accounts. Sales revenues will always be, at the end of any period, a credit balance. And all expenses, such as cost of goods sold, because they're increased on the left or debit side, will either have a debit balance or zero. The same is true for dividends, a debit balance or 0 because dividends are increased on the left. Now, let's respond to the few questions that were asked. What would cause cash to have a credit balance? Well, we've discussed that already. It's a person who's not sensitive to the balance of cash that we have and is writing checks on an account in excess of the balance that exists. That might create a credit balance. If cash does have a credit balance at the end of a period, is it really an asset? And the answer is no. I suppose you might call it a negative asset, but that really doesn't make any sense. It really is a liability at that point in time. Is it possible then also for retained earnings to have a debit balance? We've said in this problem that retained earnings typically has a credit balance. Is it actually possible for retained earnings to have a debit balance? And what would create such a balance? Well, let me share a possibility. Let's assume that a company or a business is just starting. In many cases, businesses that are in the initial stages of operation discover that they may have more expenses than they have revenues in those early months or even early years. They have a lot of costs associated with getting the business going and getting it started. And sometimes the sales don't come for, a period of time until after the business has really been established. It is very likely for startup businesses to actually have expenses in excess of their revenues. In that particular case, the company isn't generating a profit, they're actually generating a loss. We'd call it a net loss. If we were preparing an income statement and had expenses in excess of revenues in that first period, we'd have a net loss. Well, if you don't have profits, but you have a net loss, and effectively the revenues and the expenses are what give rise to this account, retained earnings, we've said that retained earnings is the net result of our revenues less expenses minus dividends. If in effect expenses exceed revenues, then theoretically we would have ultimately a negative or debit balance in retained earnings. However, if retained earnings is actually a debit balance because of expenses have exceeded revenues for a period of time, we wouldn't even call it retained earnings. What we really should call it is retained losses or cumulative losses. Many businesses might refer to it as retained deficits. It is possible for a business that is suffering losses to actually have a negative balance in retained earnings, or we'd simply recharacterize it or describe it as a retained deficit or cumulative losses from inception or something like that.